Stop scrolling. If you think this is just silver went up, you're already inside the trap. Because the story today is not a chart story, it's a delivery story, it's a supply story, and it's a policy story. Right now, three things are colliding at the exact same time. 1. China just tightened who is allowed to export silver starting January 1st, 2026. 2. Silver has been printing fresh records in the mid-90s and stalking the psychological $100 line. 3. A new rumor wave says Mexico is about to end exports of silver. And even if that rumor is not officially confirmed, the market is reacting like it might be true. So in this video, I'm going to show you what's real, what's rumor, and what the silver trap actually means. No blind hype, no blind panic, just the mechanism. As of January 20th, 2026, there is no official public confirmation of a total, blanket Mexican ban on silver exports. If someone tells you Mexico just flipped a switch and banned exports, treat that as what it is right now. A claim circulating through the precious metals community. But here's the uncomfortable truth. Markets don't wait for official press conferences. Markets trade on fear, positioning, and probability. And Mexico is the one country where this rumor hits hardest because Mexico is the world's top silver mine producer. When Mexico coughs, the global supply chain catches a fever. So what is real about Mexico? 2 confirmed policy realities and 1 huge open question. Reality 1. Mexico is tightening the mining regime. Mexico's new leadership has emphasized stricter control over how resources are developed. One visible example, halting new open-pit mining concessions, has been reported as part of a tougher mining stance. Even if your mine is underground, that no new concessions signal matters because it changes the future supply curve. It tells the market, don't expect a fast supply response. Reality 2. Mexico has the legal foundation to prioritize national interest in its resources. Article 27 of the Mexican Constitution is the backbone. It gives the state strong authority over natural resources and how they are exploited. That doesn't automatically mean export ban, but it does mean if Mexico wants to lean on producers, it has legal room to do it. Open question. Will Mexico use that leverage on silver exports? That's where the rumor comes from. You're hearing phrases like resource protection, strategic resource decree, domestic priority, and the big one, export tax on primary silver. Now listen carefully. Export tax is not the same as export ban, but in commodity markets, a high enough export tax can behave like a de facto ban because it makes exports economically unattractive. Let me make that simple. If silver is $95 and you slap a 20% export tax on the raw stream, you've effectively added about $19 of tax per ounce before shipping, financing, and refining costs. On a tight margin business, that's not a rounding error, that's a wall. So even if the policy language is tax, traders hear restriction. Even if the official stance is prioritize domestic industry, the market hears less metal available to ship. That is the first layer of the trap. Policy ambiguity creates price violence. And that's why Mexico ends exports is such a powerful headline. Not because it's confirmed, because it's plausible enough to move positioning. Why this is happening now? China, licensing, and the new gatekeepers. It sucks. Because Mexico is not acting in a vacuum. Mexico is watching China. China just implemented a tighter export licensing regime for silver beginning January 1st, 2026. And China's move matters because refined silver flow is a bottleneck. It's the part of the chain people forget. Mining is one step, refining is another, then fabrication, then allocation, then shipping, then delivery. If you tighten the permission layer, licensing, the metal can exist on paper and still be unavailable in the real world. Think of it like a nightclub. The club can be half empty, but if the bouncer blocks the door, you're not getting in. That's what licensing is, the bouncer. So when China tightens, Mexico has incentive to ask, why should we ship out strategic metal while our own EV and solar supply chains are stressed? That's the geopolitical logic. This is not a conspiracy meeting in a dark room. This is incentives. Countries are learning a lesson from 2020 to 2024. If your supply chain depends on someone else's goodwill, you don't have a supply chain. You have a hope. And hope is not a contract. Why an export tax can function like a ban, Hankortans. A true export ban is a headline event. Everyone hears it. Everyone reacts. An export tax is sneakier, it's quiet, it's legal, and it changes behavior without needing a dramatic announcement. Here's what an export tax does in practice. It pushes producers to look for domestic buyers first because domestic sales avoid the tax. It forces traders to reprice contracts because the tax becomes a new cost line item. It reduces the amount of free flow metal that hits global spot markets. It increases paperwork and compliance risk, which slows shipping and raises financing costs. So the market can experience export ban effects without an export ban. And remember, in a tight market, even small flow reductions matter. If the global system is already strained, a 5% disruption can feel like 50%. That's why the rumor is explosive, not because it must be true, because the system is fragile enough that it doesn't need to be fully true to matter. What would a real Mexican export ban look like? If Mexico truly ended exports, you wouldn't have to guess. You would likely see an official decree or published regulation, customs notices that explicitly restrict shipment categories, miners and exporters issuing formal guidance to customers, immediate contract renegotiations with industrial buyers, and very fast premium spikes in regions that depend on imported, refined silver. Until you see those hard signals, treat total ban as unconfirmed. But also understand this, the market can still reprice on the path toward restriction. The path is enough, because procurement desks don't hedge certainty, they hedge risk. The delivery story, a scene you need to picture. I want you to visualize this. It's 3:14 a.m. A procurement manager is staring at a spreadsheet that doesn't look like numbers anymore. It looks like a countdown timer. On the phone, a supplier says, "We can deliver, but not at that price." A refiner says, "We can deliver, but not this month." A logistics firm says, "We can deliver, but your shipment is now subject to approval." And then the real nightmare sentence, "Do you want metal or do you want cash settlement?" That sentence is why this is called the silver trap. Because in a shortage, your problem is not price. Your problem is access. The Tesla and solar panic. Why industry is scared. Here's where people misunderstand silver. Gold can sit in a vault and do nothing. Silver gets consumed. Silver is not just a store of value. Silver is an input in electrification, photovoltaic cells and solar panels, high-efficiency electrical contacts, advanced electronics and power management, EV components where conductivity and reliability matter. And when the price spikes, it doesn't just hit investors, it hits procurement desks, and you're hearing Tesla and solar panic because those industries are silver hungry and time sensitive. Let's talk numbers, just to anchor the reality. According to silver industry research, a battery electric vehicle can use roughly 25 to 50 grams of silver depending on design and electronics load. That's not 1 gram, that's tens of grams per vehicle. Now multiply that by millions of EVs. Solar is even more brutal. Each solar panel can contain on the order of tens of grams of silver in conductive paste and contacts, even as manufacturers try to reduce usage. Now multiply that by the scale of global solar deployment. It becomes a giant vacuum cleaner for silver, and you'll hear people say, they'll just replace silver. Sometimes, over long time horizons, yes, engineers can thrift, redesign, and substitute. But substitution is not a switch. It's a slow, expensive retooling problem. Solar manufacturers have been trying to reduce silver loadings per cell for years, and some firms are experimenting with copper or hybrid metallization. But switching materials changes yields, reliability, and long-term degradation. It changes factory tooling, it changes qualification standards, it changes warranty risk. So in the real world, the industry can't instantly remove silver without paying a different cost somewhere else. That's why scarcity doesn't just move a number on a chart, it moves decisions inside factories. Yes, the industry is thrifting, using less silver per unit over time. But here's the catch. Thrifting reduces the per unit number while total units explode. So total demand can still rise. That's why industrial buyers get nervous. They don't care about your meme chart, they care about whether they can source metal for the next production run. And this is why late 2025 gave us a major signal. Elon Musk publicly warned that surging silver prices are not good for manufacturers. That's not a meme. That's an industrial CEO admitting the metal is becoming a constraint. Now imagine you're a solar manufacturer. You've got contracts, you've got delivery deadlines. Your customers don't want excuses, they want panels. But now, China tightens export permissions, silver prices surge, and Mexico is rumored to consider restriction tools. What do? You don't wait, you secure, you pre-buy, you overorder, you pull forward deliveries, you call refiners, you call miners, you negotiate direct offtake agreements, you do whatever you have to do to avoid a line stop. Because in manufacturing, a line stop is death. 1 week of downtime can cost more than overpaying for metal. So panic is not irrational here. It's a rational reaction to the possibility that metal becomes unreliable. Why $100 is different, the psychology and the mechanics, is let's talk about $100. $100 is not magic. It's a psychological gate. Round numbers create behaviors, headlines intensify, options Activity spikes, leverage ramps up, weak hands get baited in at the top, and strong hands use volatility to accumulate or hedge. So $100 acts like a magnet and a mousetrap at the same time. A magnet because it pulls attention. A mousetrap because it triggers crowd behavior that the market can punish. So this is why the trap name sticks, because people get pulled in by the number, then chopped up by the volatility around it. What happens the moment $100 prints? The first print above $100 is not the end of the move. It's the start of a new phase. You usually see 3 reactions, almost in order. Media reaction, silver hits triple digits, which pulls in late attention. Derivatives reaction, dealers and hedgers rebalance, options hedging can amplify swings. Risk reaction, brokers tighten terms, margins rise, and levered players get forced to reduce. So the first break can be violent in both directions. Up because of momentum. Down because of forced deleveraging, so $100 is a trap door, not because it must reverse, because the volatility regime changes the second it becomes a headline. And in that new regime, the real winners are the people who prepared before the headline, not after it. The headline is the signal that the door is already narrowing. Watch delivery terms, not tweets. What the silver trap really means paper versus physical. When people say the silver trap, they're talking about a structural mismatch. On one side, paper silver, futures, options, ETPs, synthetic exposure, a world where you can create a claim on silver instantly. On the other side, physical silver, bars, industrial feedstock, deliverable inventory, a world where atoms don't multiply because you typed a trade, paper can be created in seconds, physical cannot. So the trap is this. The financial system can promise more silver exposure than the physical system can deliver in a crisis. And when supply gets pinched by policy, export licensing, taxes, restrictions, domestic prioritization, paper markets get stressed because paper markets settle beautifully until too many participants want the same thing at once. Delivery. Now, does that mean CumEx defaults tomorrow? No. Be careful with absolutist claims. But it does mean counterparty risk rises when physical availability tightens. And it does mean exchanges and large intermediaries will do what they always do in a stress event, protect the system. Sometimes that means higher margins. Sometimes that means position limits. Sometimes that means incentives to roll contracts. Sometimes that means cash settlement becomes more attractive than metal settlement. That's the trap. You thought you owned silver. But in the moment you need the metal, you realize you owned exposure. Exposure is not the same as possession. And in a supply shock, the difference matters. Is the CumEx force majeure? Fear, how it would play out. Let me explain this without doom posting. A futures market is a delivery system with financial features. Most traders never take delivery, they trade price. But the delivery mechanism is still the foundation. It's the credibility layer. If the world starts believing the metal isn't there in the right place, at the right time, in the right form, confidence cracks. And when confidence cracks, the premium shows up somewhere else. In spot V's futures spreads, in lease rates, in available now premiums, in delivery times, in product shortages at retail, and in direct contracts that bypass public exchanges. That's why you're hearing words like force majeure. Force majeure is basically the contractual way to say something outside our control has made performance difficult. Important. I'm not declaring that's happening. I'm explaining why the fear exists, because the nightmare scenario is not price goes up. The nightmare scenario is metal cannot be sourced at any price fast enough. In that scenario, paper prices can lag reality. Physical price can run away, and the gap becomes the story. That's how you get people whispering about $200 physical, not as a forecast, as a logic path. Putting Mexico back in the center. Why friction is enough. Now bring Mexico back into focus. Even without a formal ban, here's what can happen in real life. A new tax makes exports less profitable. Domestic buyers get priority contracts. Compliance requirements increase friction. Producers quietly shift sales into preferred channels. Logistics bottlenecks create delays that feel like shortages. None of this needs a dramatic announcement. Supply can tighten through paperwork, and when the market senses that possibility, it front-runs the shortage. That's why you see sudden spikes, violent pullbacks, then higher floors, because the market is trying to reprice not just metal, but access. Access is the new currency. So when someone says Mexico ends exports, ask a better question. Is Mexico making exports harder, slower, or less attractive? Because less flow is enough. And less flow in a tight market is how you get a run at $100 and beyond. What we know about price right now: silver has been trading at historic highs in the mid-90s after printing fresh records around $95, $96. Gold has also been setting records above $4,700. That matters because gold is the psychological permission slip. When gold breaks records, it legitimizes hard asset demand. And silver is the smaller, more volatile market. So when capital rotates into silver, moves can look insane. That's why you see people throwing out targets like $100, $107 and higher. Not because the market is predictable, but because once you're in a squeeze dynamic, price discovery turns chaotic. In other words, the chart becomes a symptom, not the cause. The supply deficit: why the system feels empty even with mines running. Here's the part most people miss. A deficit doesn't mean no silver exists. It means the world wants more silver this year than the world can supply this year. And multiple industry reports have described recent years as deficit years for silver. Some estimates even put the shortfall in the hundreds of millions of ounces in the tightest years. Why does that matter? Because deficits get funded by above-ground inventories. You draw down stockpiles, you drain vaults, you melt down old bars, you recycle what you can, and that works until it doesn't. Because recycling is slow, and not all silver is easily recoverable. Silver is spread across billions of electronics, contacts, and tiny components. That metal isn't sitting in one neat pile waiting to be returned to the market. So after several consecutive deficit years, the system starts to behave differently. Less buffer inventory, tighter leasing and borrowing markets, greater sensitivity to shipping delays, bigger price reactions to small policy changes. That's why rumor can move price so violently right now. The market is already operating closer to the edge. How this moves from investor story to industrial arms race. Here's the key shift you need to understand. A normal commodity rally is mostly investors and traders. A strategic metal rally turns into an industrial arms race because the biggest buyers aren't comment sections. They're procurement desks. They're national champions. They're manufacturers with contracts. They're supply chain managers who are judged on one thing: did the parts arrive? And when those buyers get nervous, they don't nibble. They lock. They sign long-term contracts. They secure shipping lanes. They pay premiums for guaranteed delivery. They build buffers. This is why the physical market can decouple from the paper market. Paper says, here's the price today. Physical says, cool, can you deliver? And the moment the answer becomes maybe, the price you see on the screen stops being the full story. 3 things people get wrong in a silver squeeze. Myth 1. High prices will instantly create new supply. Reality. Silver is largely a byproduct metal. New primary projects take years, even expansions take time. Myth 2. If the price is high, metal will show up. Reality. Price does not automatically fix licensing, shipping, refining, or domestic priority policies. Myth. 3. Paper and physical are always the same. Reality. They track until stress breaks the link. Under stress, allocation matters more than screens. The checklist: what to watch in the next 24-72 hours. Let me give you a clean, non-hype checklist. If the Mexico export narrative is real, you will see evidence in one of these places. 1. Official government language. Look for formal statements from Mexico's trade or economy authorities, not anonymous screenshots, not sources say, actual published language. 2. Customs or compliance updates. Sometimes the first signal isn't a press release, it's a quiet rule change that adds friction. 3. Producer behavior. Watch what major miners and traders do, not what they tweet. Are they shifting to domestic buyers? Are they slowing export shipments? Are they renegotiating terms? 4. Premiums and availability. The real panic shows up in premiums, delivery times, and out-of-stock notices. Spot price can lie. Availability doesn't. 5. Spreads and stress signals. When a market is tight, spreads, lease rates, and nearby views forward pricing can start screaming before headlines do. This is how you watch the plumbing, not the propaganda. The real risk: cash settlement versus metal settlement. Now let's talk about the part nobody wants to face. If physical supply tightens enough and too many paper holders try to convert exposure into metal, the system has to choose. And systems choose survival. That doesn't mean instant collapse. It means the rules get used, margins go up, leverage gets squeezed, weak hands get forced out, and the market tries to cool demand without having to deliver more metal. That is literally how traps work. The price whipsaws. People get shaken out. Then the metal ends up in stronger hands, industrial hands, sovereign hands, long-term hands. So the trap is not only about shortage, it's about behavior. It's about how volatility transfers metal from impatient hands to patient hands. What you should do with this information. A framework, not a trade. Let me be crystal clear. I am not telling you to buy or sell anything. This is not financial advice. This is a framework. If you are watching silver, stop asking, where's the next price target? Start asking, where's the next bottleneck? Because the bottleneck drives the premium. The bottleneck drives the panic. The bottleneck drives who gets metal and who gets cash. And today's bottleneck risk is export flow. China tightened export permissions. Mexico is rumored to consider restriction tools. And electrification demand is still hungry. That's why this feels like a trap. Because once you see it, you can't unsee it. The system is built on promises. And promises get tested in shortages. Practical actions without hype. Manufacturers, investors, and everyone else. If you're a manufacturer or you work in procurement, the playbook is boring but urgent. Audit how many weeks of silver-bearing components you actually have on hand. Identify which suppliers depend on export permissions or cross-border refining. Stress test your contracts. What happens if delivery slips by 30 days? Diversify sources where possible and explore recycling loops, because scrap becomes strategic in shortages. Start asking for guaranteed delivery language, not just best effort, because wording becomes the battlefield. If you're a normal viewer trying to make sense of the noise, here are the 3 questions that cut through everything. 1. Is the constraint price or availability? 2. Is the constraint local or global? 3. Is the constraint temporary logistics or policy-driven restriction? If the constraint is policy-driven, it tends to last longer than people expect. And if you're trading paper exposure, remember the core distinction. Price exposure and delivery rights are not the same thing. In calm markets, they feel identical. In stressed markets, they separate. That separation is the trap. So here's the question I want you to sit with. If silver is strategic, not just precious, what happens when countries start treating it like oil? Not with tanks, with paperwork, with licensing, with taxes, with domestic priority. That is how the silver trap closes. And if you want my next update, I need you to do one thing. Comment one word below. Trap. If you think physical decouples from paper. Delivery. If you think the market finds metal and calms down. Either way, watch the flow, because the flow is the truth.